Anything else?
So in that types of bonds in that handout, there are few questions. Will it be?
Okay, what are those?
So what do you mean by that deferred coupon bonds?
That means like deferred dividends on the due date. They don't pay the coupon. They defer it for a future date.
That is agreed at the beginning, at
At
the
the
time
beginning.
of issue.
Yes, yes, yes. Sometimes it's like that. Yes, there are. So say for the first 2 year, for the first year, there's no coupon. From the second year and onwards, they pay with that coupon or something like that. But now very rarely use those options.
So what is mean by inverse floaters?
Inverse floaters. So
Yes.
we discuss about floating rate notes.
Yes.
So in that floating rate note equation, if you can remember, it is the benchmark rate plus the margin. So whenever the benchmark rate increases, coupon rate increases. Whenever the benchmark rate decreases, coupon rate decreases. In the inverse floater, it happens other way around. When the interest rate goes up, coupon rate goes down. When the interest rate goes down, coupon rate goes up. Move in the opposite direction. That's why it's called inverse floaters. Coupon rate moves against the benchmark rate.
So other thing is what is the dual currency bonds?
Dual currency bonds include two currencies. Say we issue a bond in dollars, but maybe coupon payments are made in some other currency. Two currencies are involved in a particular bond. Generally, when we say Sri Lankan government bonds denominated in rupees, investor buy it by paying rupees, and even the government coupons and maturities are paid in rupees. In dual currency, it's not the case. They may pay in other currencies. But what is other currencies given at the time of issuing? What are the conditions? All those are given. And there will be exchange rate risk.
Okay, sir, there's another one that is bullet. What is the mean by bullet maturity?
Bullet maturity, as we discussed, only on the maturity date you get the face value. Principal is paid as a lump sum on the maturity date.
That is common for every bond, no? Sir?
No. There can be bonds where some of the principals paid before maturity. But again, very rare. Yes. The most common way is bullet maturity.
So there's another one that is asset-backed security. What do you mean by asset-backed security?
That means it's a securitized product. Say you have a loan portfolio. So based on the income or the cash flow coming through that loan portfolio, you can issue a bond. Then the payment to the bondholders solely depend on that loan portfolio, not from any other assets. So the asset back means the bond is backed by the loan portfolio. That's the asset. Likewise, it can be credit card payments, or it can be loans, or it can be mortgages, or it can be a collection of all those things. However, there are some set of assets which gives the cash flow to make the payments to the bondholders. That cash flow cannot be used to pay any other debt.
So if there is any problem with regard to that those assets, there will be
That passes to the bondholders. That is also there.
Okay, sir, thank you.
Anything else? So last week we discussed options. What is an option? Option gives a right to the buyer. That's what the simple interpretation or simple definition. Option buyer gets a right to do what? Either to buy the underlying asset or to sell the underlying asset on a period. The option buyer can either buy the asset or sell the asset at a pre-agreed price during that lifetime. So, but in a particular option contract, one option contract, the right the buyer gets is only one of those, either to buy or either to sell, not both. Only one of those, remember that. Then to buy the option, the buyer has to pay the premium to the seller. So to the seller, there's no right, and to the buyer, there's no obligation other than paying the premium. Once the premium is paid, buyer has no obligation, but buyer has the right. But seller has the obligation. Whenever buyer of the option comes and say, I want to exercise my right, then the option seller cannot say no. No, he has to meet that obligation. So that's the basic. Then we discuss about two types of options depending on what is the right is given to the option buyer. If it gives a right to buy the underlying, we call that sort of option as a call option. So in summary, call option gives the right to buy the underlying asset. The option buyer gets the right to buy the underlying asset. That's a call option. In a put option, the buyer of the put option gets the right to sell the underlying asset. Sell the underlying asset. So that's the difference between call option and put option. Then depending on the time frame when the buyer of the option can exercise his or her right, again we categorize options into two groups. One is American option, the other one is European style option. In the American style option, buyer has the flexibility to execute the right on or before. That means any time before the maturity, the buyer can exercise the right. But in an European option, there's no flexibility. Only on the maturity date, the buyer can exercise the right. Only on the maturity date. So that's the difference between American option and the call option, European style option. So all those things we discuss. Put option, right to sell the asset at a specific given price. American option, you can exercise the right any day. European only on the expiry day. And I told you, always think or remember options from the buyer's point of view. Then the opposite is true for the seller of the option contract. So those are the things that we discuss. Any question? Is it clear? What is a call option? What's a put option? What is the American style option? What's the European style option? And most of the examples that we are going to discuss would be European style options. And I talk about the premiums, difference in premiums in American style options and the European style options. Since American style options gives the buyer more flexibility, premium is higher than the similar European option. Okay, let's go back to this. You bought a December 2020 put option on shares. Let's go. Let's see whether we have. Okay, we have a call option. You bought a December 2020 call option on shares of ABC company. Price of a December 2020 call option 35.75. Strike price of the call option 66. Here assume this premium is per one share, and strike price also per share, shares of ABC company. Now assume this is an European option. December, so you typically you buy this, or not typically, definitely you should buy this before December 2020, maybe September 2020 or somewhere before December. Assume on the expiry date, price of this share is first one is 66, $70, $64 on expiry. On the expiry date, the price of the option, price of the shares is, say, consider case 1, 70. What do? You have bought this option. What do you do? Now you are here. On the expiry date, price of the shares of ABC company, $70 per share. You have bought a call option by paying $35.75 premium, and the strike price of the call option is 66. What do you do?
So you can exercise?
You can exercise. What does it mean? Exercise your right. What does it mean?
We can purchase.
You can purchase shares at what price?
66.
At 66, because that's the agreement. The option seller has agreed to sell you shares in December at a price of $66 per share. That's the right that you have. You can buy that shares by paying $66 per share. So now the market price is 70, above this strike price. Here the spot price is greater than the strike price. So you have a gain there. So you exercise your right. You go to the seller of the option contract and say, see, I want to buy shares at $66. Number of shares depend on the number of options that you have bought. So you can buy shares. It is worth for you to buy at 66 when the market is at 70 rupees. So now let's assume the second scenario, when the market price is at 66. Now what do you do? At this point, spot price is same as the strike price. What do you do?
So you can buy or leave it as it is.
Yes, either you can buy or let it expire. You don't do anything. We call that the let the option to expire. Whether you go to the market and buy from the market paying 66, or you go to the option seller and buy it, there's no difference. So you are in a indifferent situation here. So either way you can do that. Or you don't want to buy, you can do that as well. Not necessary that you have to buy. In the previous instance, that means when the price is 70, remember, as the option buyer, you have to exercise your right. You have to inform the counterparty, hey, my option is expiring on this date and I want to buy shares. So that you have to tell or inform the counterparty. Counterparty won't come and tell you, see, your option is expiring, you can buy, you have a gain here, you can exercise your right. That won't happen. As the option buyer, you have to inform the option seller that you want to exercise your right. If you don't inform and you don't exercise your right, the option will expire. Later you cannot ask anything from the seller of the option. Okay, now let's consider the third option or the third scenario. When the spot price is less than the strike price, what do you do?
So in the first scenario, can we, as buyer, can we leave it as it is? So definitely we have to
No,
exercise our right.
you don't have any obligation. So if you don't want to purchase, you can let it expire. But as a rational investor, you won't do that. Is it clear?
Yes, sir.
Okay. What do you do at this instance? Third scenario. When the spot price is less than the strike price, what do you do?
So you are not exercising.
You don't exercise your right. Why?
Buying from market is cheaper.
Yes, you can buy from the market at paying 64 instead of 66. And you don't have any obligation. So you can let it expire. And if you really want to buy, go to the market and buy it from the market. Is it clear? Any questions on that?
So if we do not exercise our right, what will happen to the premium? We won't get back.
You won't get, at the beginning I said, once the premium is paid, it's paid. You cannot ask that back. It's like you are buying an insurance. To buy the insurance, you pay the premium. You don't get it. Whether you make a claim or not, you don't get it.
So if you want to buy that shares, we have to pay that strike price. No?
Yes.
Okay.
Okay, now tell me forwards or futures. What's the difference between a forward and an option?
With the forward, you have an obligation to meet the condition at the maturity, but option gives you a choice. Either you can exercise or you can leave it.
Yes. If you buy a forward contract, irrespective of whether the price is 70, 66 or 64, you have to buy at this price. You have an obligation. In an option, you can make the decision. You have the choice either to exercise your right or not. So whenever you have the gain here, you need not to go to the option seller and buy the asset at the strike price. You can go to the market and buy it at the market price. So whenever the market has moved in your favor, you can get that advantage. But in a forward, you can't do that because you have the obligation to buy it at the forward price that you agree. So that's the advantage of having or using an option contract instead of a forward. What is the cost? You don't get anything for free in the financial markets. What is the cost? What's the cost of choosing option instead of a forward?
The option premium, that is, you can't get it back, right?
Yes, you have to pay a premium upfront. It's not the price that you pay to buy the underlying asset. Whether you buy the underlying asset or not, you have to pay the premium to buy the option itself. But in forward, it's not like that. Whatever the agreed forward price, it can be at a premium or it can be at a discount. Whatever the price that you agree, you buy the underlying asset at that price. But in the option contract, to get the right, you have to pay a premium, which you won't get it back. That's the cost. Clear? Any questions? Now we'll consider the put options. Let's see what to do. Premium is 70, strike is 378. So assume again price of the underlying asset $400, $378 or $350. Now tell me, what do you do when the price is at 400? On the expiry date, price is at 400. What do you do?
So do not sell.
You don't exercise your right. Why?
You can sell it at highest market.
Yes. If you exercise your right, you can sell it at only at 378. That's the agreed price. Whereas in the market, you can sell it at a higher price of 400. So you don't exercise your right. When the spot price is higher than the strike, you don't exercise your right. Now, at this instance, what do you do? When the spot price is exactly same as the strike price. Now, what do you do?
So can exercise or not? Both can be.
Again,
Exercise option, right? You have already paid the premium, right?
already paid the premium, yes.
You have already borne a cost there,
So,
yeah, it's indifferent. Yeah, sorry. You can either exercise or
either exercise or not. Yes, you are indifferent. Then it's at 350. Spot price is less than the strike price. What do you do?
Exercise. Sir.
You exercise. What does it mean? In a put option,
You sell, sir.
you sell the asset at what price?
378.
At 378. If you exercise your right, you do the transaction at the strike price. So therefore, in this instance, you sell it at 378 when the market is 350. What is your gain?
$28.
So here the difference between 278 and sorry, 378 and 350, 28. You get this as a gain, but we call it this as the payoff, because whether it's a profit or loss, that depends on the premium as well. We have to consider the cost that you incur to buy the option contract. Even in the previous example, when the spot price is 70, it's about your strike price, then you make a profit. You receive some cash flow, you make a gain here, but whether it's a real gain or not, that depends on the premium that you pay. Any questions? Is it clear?
So in the slide it has mentioned as
Sorry?
the last slide. So,
Which one?
yes, it has mentioned as under last line has mentioned a call option. That's incorrect.
Ah, yes, yes. This should be put option. So this is another example. The underlying message now we have discussed here earlier. However, say consider this again a call option. You are buying a call option with December 2020 maturity price. That means the premium is $35.75. Strike price is 66. Spot price of the share at the expiry is 80.75. So if the spot price on the expiry date is 80.75, what do you do when the strike price is 66? What do you do in this instance?
We exercise.
You exercise your right. Then you get a gain, or you get a cash flow of the difference, 14.75 cents. Sorry, $14.75. Is it correct? You get the cash flow equal to this difference. If we put that differences in a graph at different prices, spot prices on the expiry date, what would happen? Can you see this? Can you see this?
Yes, sir.
Yes. Okay. On the expiry date, so this spot price is on the expiry date. If the spot price is equal to the strike price on the expiry date, what would happen? Either you exercise or not, it doesn't matter. You don't get anything. Correct? Because whether you buy from the market or you buy from the option seller, you paid the same price, this strike price. Therefore, there's no gain to you. But what would happen, say, what was the strike price? This was 66, no? What would happen if the price is 80? You can buy the underlying asset paying $66 when the price is at 80. What is your gain? Or what is your payoff? What is the amount that you receive as the difference? It's the $14. What would happen if it is 75? It would be 9. Likewise, it will change. What would happen if it is 100? If it is 81, this will increase by $1. For an increase in $1 of the underlying price, your payoff also increased by $1. So beyond this point, for each dollar the price increases, payoff or the cash flow that you are going to receive increase by $1. So therefore, it will be a straight line like this. But what would happen if it is 50 or 30 or 0? What do you do? When the spot price is less than strike price, what do you do in this area? Do you exercise your right?
No.
No.
You buy from the market, right?
Will you get any cash flow through this call option? No, you don't get anything because of this call option. You can buy it from the market, that's a different story, but through this call option you don't get anything. So your cash flow is 0. This whole diagram, we call it as the payoff diagram. So this is the strike price. For a call option, when the spot price remains below or equal to the strike price, payoff is 0. The moment the spot price move above the strike price, our payoff becomes positive and increase in a linear manner equal to the same amount of the price increase. If the price increased by $1, payoff increased by $1. So this is a straight line. This is sorry. So this is the payoff, but what is the profit or loss? Your profit or loss depends on the not only the payoff and the cash premium that you paid. At this, in this area, though you don't get anything, you have already paid the premium. So you get a zero cash flow, but you already have made the premium. So therefore you make a loss up to this point. This difference is equal to the premium that you paid. Even in this area, what would happen? This gain is reduced by the amount exactly equal to the size of the premium that you paid. So therefore, your profit line would be like this. The second diagram is the profit diagram. So you can see, even though you exercise your right just after the strike price, just slightly above the strike price, you make a loss until it reach a point somewhere here. We call it the break even. Break even point. What would be this break even point? The spot price should equal to the premium plus the strike price. At that point only, you break even. You don't make a loss, you don't make a profit. When the price increases beyond that break even point, you start to make profit. That is given in this picture. So in summary, this is the profit diagram. If you have to do the payoff diagram, straight lines, and these two lines are parallel. What is that difference? This is the premium. So this one we call the payoff. This is the profit. And the break-even point, you get it at this point. Strike price plus the premium. But remember, even though you make a loss in this area, it doesn't matter. As a buyer of the call option, you should exercise your right. Even when the spot price is somewhere here, you should exercise your right. Unless what would happen? If you don't exercise your right, what would happen?
Your loss will be more, sir.
Your loss will be equal to the premium. So that means this line goes like this. Then jump here, and so even you make a loss in between this strike and the break even, you will minimize your loss. So therefore, whether you make a profit or loss, it doesn't matter to take a decision whether you exercise your right or not. The decision based on the relationship between strike price and the spot price. Whenever the spot price is higher than the strike price, you should exercise your right for a call option. Is it clear? Any questions?
So excuse me, why do you call it as a long call option?
That means you have bought the call option. Long means you bought. Your position is long.
Okay.
Any other questions? Anything else? Now tell me, what would be the shape of a profit diagram for a short call? That means you have sold the call option. What would be the shape of the profit diagram?
So it will be downward sloping from the exercise.
So I'm straight away asking the profit, not the payoff.
So
Okay, if assume the price is somewhere here, what would happen? What would be the action of the option buyer?
they will not exercise.
They will not exercise. So what is your profit?
Premium.
You collect the premium. So you make a profit equal to the premium until this point. Even at this point, whether the buyer of the call option exercise his right or not, you get the premium. Even the buyer exercise his right at the strike price, which is equal to the spot price. As the seller, you don't incur any loss. So you get a profit which equals to the premium. After this, what would happen? When the price is above the strike price, option buyer will exercise his right. Then you have to deliver some asset which has a higher market value, but you get a lower price. Then what would happen? You start to incur a loss. So your profit goes down like this. Again, the same break-even point applies here. Clear? Is it clear?
So this is from a writer's point of view, no, sir?
Yeah, that's right. Short call.
Okay, sir. Okay.
So this is the long call payoff. This is the short. So you can see the relationship. As I mentioned earlier, it's the completely opposite. When the buyer makes a loss, seller makes a profit. When the buyer's loss reduces, seller's profit reduces. When buyer makes a profit, seller makes a loss. So this blue color line is exactly the mirror image of the red color one on this x-axis. So that's why I ask you to always think from the buyer's perspective, and then you can flip it over to get the other side. Is it clear? Any questions? Okay, if you don't have questions, let me ask few questions. What is the maximum loss for a call option buyer? What is the maximum loss for the call option buyer? What is the maximum loss for the call option buyer?
So that would be the premium.
That's equal to the premium. You can see in this graph, this is the profit diagram. So this is 0. This is minus figures. That's the maximum loss, which is equal to the premium. So the maximum loss for the call option buyer is the premium. What is the maximum gain? What's the maximum gain? For the maximum profit?
It's unlimited.
It's unlimited. So why? In this area you can see profit. Whenever the spot price increases, profit increases. There's no limit. At any time, what is the profit? We'll come back to that later. How to denote the profit in terms of strike price, spot price, and the premium. So this graph you can understand. So then what is the break-even point? It is the strike price plus the premium. Correct? So it is given here. The maximum loss is premium. Remember, this is for a long call option. If you buy a call option, this is applicable. Maximum loss is up to the premium. You don't lose anything other than the premium, but there's no limit into the profit. It can be unlimited. Break-even price is the strike price plus the premium. At this point, you break even your profit and loss. You don't get anything. Is it clear? Any questions? Okay, if you don't have any questions, what is the payoff for the seller of the above call option? So we did that. We answered that question here. So this is the payoff for the seller of the call option. It is just the mirror image on the x-axis. So you may have to note it down here. It's given. This is the answer. When the spot price is below the strike, buyer won't exercise the right. So the seller just collect the premium and go away. But whenever the spot price is above the strike price, buyer will exercise his right. Then the seller has to sell the underlying asset at a lower price than the market price. That difference is a loss for him, but he has already collected the premium. The difference is the profit or loss. So, but whenever the spot price goes above the strike price, strike plus premium level, definitely the seller makes a loss. It goes down. Now tell me, what is the maximum loss for the seller of the call option? What is the maximum loss for the seller of the call option? This is the profit diagram. What's the maximum loss?
So unlimited.
It's unlimited.
Indefinite.
Indefinite. So whenever the spot price increases, the seller makes losses. Say again, for the buyer, unlimited profit. For the seller, unlimited loss. What is the maximum profit for the seller? What's the maximum profit for the seller?
Premiums.
Sorry?
Premium.
It's only the premium. What he gets, whatever the premium, that's it. So premium is the maximum profit. Whenever the spot price remains below the strike price, this area, then the seller of the call option gets the maximum profit as the premium. So again, the break-even point, same as earlier, strike price plus premium. So that is summarized here. For a short call option, that means seller of the call option, the maximum loss is unlimited. Maximum profit is premium. Break-even price is stock price plus premium. Okay, which one is risky? Buying a call option or a selling a call option? Buying a call option or selling a call option? Which one is risky? Selling a call option. Why? The loss can be unlimited. Now think about a put option and try to draw the payoff and the profit diagram. You can use these figures just to get some idea, but not necessary to use these figures. First, we'll try to draw the payoff. This is the strike price. Okay. It's for the long put. When the price is lower than the strike price, spot price is lower than the spot price, as a put option buyer, what do you do? In this area, what do you do? The price, spot price is less than the strike price. You have a long put option. That means you have bought the put option. What do you do?
We exercise.
You exercise your right. So then what would happen? You get the difference between strike price and the spot price. So when the price is 0, what do you get? You get something equal to strike price, because you can sell your asset at the strike price. Even the price is at 0, you can sell it at the strike price. So you get the difference between X and 0. So this is your payoff. But when price increase towards strike price, what would happen? Your payoff goes down like this. This is a straight line. Then above the strike price, what do you do? When the spot price is higher than the strike price, as a put option buyer, what do you do?
Do not exercise.
Sorry?
Do not exercise.
You don't exercise your right, because you can sell the asset at the market price at a higher price than the strike price. So you don't get anything. So this is the payoff diagram for a long put. But what is the profit diagram? So this payoff will go down by an amount equal to the premium. So it will be something like this. What is this difference? That difference is the premium. And again, there's a break-even point. What is this difference? What is this difference?
Premium, sir.
Again, it is the premium. Now, then what is your maximum loss as a put option buyer? As a put option buyer, what is your maximum loss?
Premium, right?
Premium. What is your maximum gain?
The exercise price. Less premium.
Exercise price less premium. This is your maximum profit, maximum gain. Exercise price minus premium. What is break-even point? If this difference is equal to the premium, what is this point? What is the price here?
So that is strike minus premium.
Strike minus premium. Okay, is it clear? So this is the diagram, profit diagram for a long put option. Whenever the market price remains below the strike price, buyer of the put option will exercise his right. So just below the strike, there will be a loss, but the loss will decrease when the price goes further down. The maximum profit will be at when the price of the underlying asset equals to 0. The break-even point comes here as the strike price minus the premium. Maximum profit comes here as the, again, strike price minus premium. Maximum loss occurs when the underlying asset price goes above the strike price. You lose your premium because you don't exercise your right. You can sell the asset at the market price. From option, you don't get anything. So now you can draw the payoff or the profit diagram for a short call, short put option. What would be the diagram for a short put? What is the shape? This is for the buyer. Then what would be the diagram for the seller? When the buyer makes a profit, seller makes a loss. At the break-even point, both are at break-even. When the buyer starts to make loss, that becomes the profit for the seller. So this red color line is the profit diagram for the short put option. What is the maximum profit? What is the maximum profit for a short put?
Premium.
That's the premium. Maximum loss? What's the maximum loss?
Strike price minus premium.
Sorry?
Strike price minus premium.
Strike price minus premium. The maximum gain for the option buyer is the maximum loss for the option seller. So option buyer get a maximum gain of strike price minus the premium. So the same is the maximum loss for the put option seller. Break-even point for both long party and short party, break-even point is the same, strike price minus premium. Now answer me this question. Whether it's a call or put, irrespective of that, buying an option or the selling an option, which is more risky? Buying an option or selling an option, which one is more risky?
Selling an option.
Selling an option. Why?
Loss is unlimited.
Sorry?
Loss is unlimited.
Loss is unlimited. Even here you can see it is sort of unlimited. You can lose everything from strike price. So if it can goes negative, this will go further down. But not only loss is unlimited, gain what is the gain for the option seller? What is the gain for the option seller?
Unlimited.
Unlimited? What is the gain for the option seller, not the buyer? Loss is unlimited. Gain?
It's a premium.
It is only the premium. So the gain is limited, equal to the premium. Maximum gain the option seller receive is the premium. It is limited. So that's why selling option is an risky strategy, because your gain is limited, whereas your loss is unlimited. So selling options is riskier than buying option. But out of selling selling put option and selling call option, which one is more risky? Selling a call option, because there's no limit to the loss of a short call option. It can be really unlimited, but in a put option, at least it will be limited at the strike minus premium. So if you go to this, you can see short call option, the loss can be extended without any limit. It can go further down. So the most riskiest strategy is selling call option. However, when compared to buying option and selling options is riskier than buying options, irrespective of whether it's a call or a put, because you have a limited gain, whereas you have unlimited loss. Any question? So basically, payoff and the profit, how to calculate profit and payoff is covered now. Is it clear? Do you have any questions? Whether you have any questions? If not, try to answer this question then. So an investor buys 3 future call options with a strike price 5,200 for a premium of 12. At expiry, the cash index stands at 5,210. Is he making money or losing money? Will he exercise his strike?
Yes.
Yes. Why?
He can buy at a cheap price.
It's a call option, and the investor has bought the call option. Strike price is 5,200, and on the expiry date, market price is 5,210. So the spot price is higher than the strike price. So definitely, as a long party, you should exercise your right. So this is the answer in summary. Underlying index value is greater than the strike price, so it is worth to exercise your right. What is the gain on the exercise only? Is the difference between spot minus strike. So you get a gain of 10 index points. However, he has paid premium of 12 index points. So therefore, overall, the position is a loss of 2 index points per contract. Clear?
So he has bought 3.
Yes, that's why it says per contract.
Does he have to pay or that 12?
Sorry?
Does that buyer has to pay 12 for a contract or it's the whole total?
Yes, this is the premium per contract.
Per contract he has to pay 12, no?
12, yes.
Okay.
So as similar to in futures, index point value of index point is 10 pounds. So he lost on 3 contracts, 2 index points per contract, 3 contracts, and 10 pounds per index point. So altogether he loses 60 pounds. Try this one again, buy but put options. strike price is strike price is 5,300. Spot is 5,280. So strike is higher than the spot. What do? You are a put option buyer. Strike price is higher than the spot price. What do you do?
You can sell.
What is your decision? Huh?
You can exercise. Sell.
You exercise your right. Then what is the gain? The difference between 5,300 and 5,280, you get 20, but you paid a premium of 15. So your gain is only 5 index points. 5 index points per contract. You bought 7 contracts. Value of index point is 7. So your profit is 5 into 7 into 10, 350. So underlying index value is less than the strike price. So you should exercise your right. Gain on the option exercise is the difference between the strike and the spot. So you get 20 index point. However, you paid the premium of 15 index points. So overall option gain is only 5 index points per contract. So you bought 7 contracts. Altogether profit is 350 because 7 contracts, 5 index points gain, and value of 1 index point is 10 pounds. So this is what we discussed. Short put option payoff diagram and the summary. So this gives you the summary what we discussed so far. So your position is long call. What is your risk? Your risk is limited to the premium that you pay. That means that is your maximum loss. As a call option buyer, you won't lose anything other than the premium. That's the maximum loss. What is the reward or your gain? There's no limit. You can make an unlimited profit. So that's why reward is unlimited. This is for a long call option. So when it comes to short call, that means you have sold a call option. Then what you have to do? Just cross these two. Whatever the reward for a long call would become the risk to the short call. So the risk for the short call option is unlimited, whereas the reward is limited to the premium. Same thing in a long put option. When you buy the put option, your risk is limited to the premium. So you can see whether you buy a call or a put, irrespective of whether it's a put or a call. If you buy the option, your maximum risk is losing the premium. You don't lose anything more than the premium. But theoretically, rewards are unlimited in both situation, but in a put option there's a practical limit. That means you get the maximum profit when the asset price falls to 0. So the maximum profit would be the strike price minus the premium that you paid. So short put option, again what you have to do, change the position. So even though there are 4 combinations, what you have to remember or understand is only 2. What is the position for a long call and a long put? Then you can convert it into a outcome for a short call and a short put. It's like in any other transaction. If the buyer makes a profit, what would happen to the seller? He's losing. So same concept can be applied here. Any questions? Any questions? Okay, if you don't have any questions, we'll move forward. What are the risks of options? So other than that market risk, depending on whether price goes up or goes down, you make a profit or a loss, irrespective of whether you have a put option or a call option, whether you are a buyer or a seller. Depending on your position, direction of the market will decide you whether you are making a profit or a loss. If you have bought a call option, price goes up, it's good for you. But if you have sold the call option, price goes up, it's not good for you. If you bought a put option, price goes up, it is not good for you. If you have sold the put option, price goes up, it's good for you. So depending on what is your position, whether price going up or the going down is beneficial for you, that's the market risk. It is there in the option. Other than that, we have the counterparty risk. But again, this is not symmetric like in a forward contract. In a forward contract, both parties takes the counterparty risk. Not sure whether the other party, your counterparty, would deliver you on the maturity date. But in an option, not both parties takes the risk. Option seller does not take any counterparty risk because option buyer has no obligation towards the option seller. Only thing is the buyer has to pay the premium. Unless the premium is paid, there's no contractual obligation from the seller's side as well. Once the premium is paid, the option seller has the contractual obligation towards the option buyer. So therefore, option seller does not assume any counterparty risk. But from the option buyer's point of view, it is different. Why? Once you buy the option, you have the right, but the counterparty has the obligation. Then the risk is whether the counterparty will fulfill the requirement on the expiry date or whenever you are going to exercise your right, depending on whether you have the call, whether you have an American style option or a European style option. So when you try to exercise your right, the counterparty should exist. The party who collects the premium should exist there in the market, and should be in a position to honor your transaction. So therefore, option buyer takes the counterparty risk, whereas option seller does not take any counterparty risk. So we'll come to what does it mean by at the money or in the money. So that means indeed option buyer mostly face the counterparty risk when your option is worthwhile to exercise. You have some positive cash flows on that. So this is a sort of a calculator or summary again. How do you calculate the profit or loss? Sorry, is there any question? Is there any question, please? Okay, so though it's called a calculator, it doesn't calculate anything, but it will give you a guidance how to calculate the profit or loss depending on your position and depending on the market. So in this column, first column, it shows your position, whether you have a long call option or a short call, long put or a short put. Then the relationship between expiry price, that means on the expiry date, what is the spot price and what is the strike price that you agree. The second column shows when the strike price, that means, sorry, expiry price, spot price is less than the strike. What would happen? In the third column, it shows when the spot price is higher than the strike price, what would happen? So for a long call option, when the spot price is less than strike price, what do? Do you exercise your right? When the spot price is less than strike, when you have a call option, you bought a call option. When the spot price is less than strike price, you don't exercise your right because you can buy the underlying asset from the market at a lower price than the strike price. That means whatever you agree price that you agree. No need to pay that price. You can buy from the market at a lower price. So, but you make a loss which is equal to the premium that you paid, because to buy the option you have already paid the premium. You are going to lose it. But what would happen when the spot price is higher than the strike price? Then you make a gain. The gain is the difference between expiry price, that means the spot price, minus the strike price, minus the premium that you paid. That is your gain. In a short call, so whether it's a short call or a premium put, your maximum gain is equal to the premium. So you can see this is premium, this is premium. You won't get anything other than premium as a short party of a option. So when a short call is there, spot price is less than strike price, buyer won't exercise his right, so you make a profit equal to the premium. But on the other side, when the spot price is higher than the strike price, the buyer of the call option will exercise his right. Then whatever the profit become for the buyer would become the loss for the seller of the call option. So remember, here I have made it a plus and hence have changed these to strike price minus expiry price. So this is a loss. In the long put, again, when the spot is less than strike, buyer will exercise his right. This is the premium. Strike price minus expiry price. Minus premium is the gain for the put option buyer. The loss would be when the spot price is higher than the strike price. That means you can sell at the market price instead of the agreed price. So therefore you don't exercise your right. You let the put option to expire, but you lose the premium. When you lose the premium as a long party, as a short party, make it as a profit. So same thing here. When the spot price is less than the strike price, option buyer would exercise his right. Whatever the gain for the option buyer would become the loss to the option seller. So I'm not asking you to remember this table. Don't do that. I think it would be difficult, but try to understand as an option buyer, what do you do in these two scenarios? When the spot is less than X, spot price is less than strike, and spot price is greater than X. As a put option buyer, what do you do here? As a put option, what do you do here? As a call option, what do you do? When the spot price is less than strike, when the spot is greater than strike, what do you do? Based on that, and you can decide whether you make a profit or a loss. If you have the concepts in your mind, it is easy to do that without remembering these equations. Any questions? So far we discussed about call options and put options, and we just introduced American style and European style options. So whatever the options we discuss, strike price is fixed. At the beginning, we fix the strike price. At what price the option buyer can buy the asset or option buyer can sell the asset. The strike price is given. The time frame is fixed. And depending on whether you can exercise your right only at the end or on the expiry of the option or any time during the option. So based on those, we classify options into different categories. So there can be 4 combinations: American style call options, American style put options, European style call options, and European style put options. So now we are going to discuss few more type of options which are depends on the price path of the underlying asset. Because as I mentioned earlier, the strike price is fixed. So whether it's a European style option or an American style option, what matters is what is the price of the underlying asset on the date that you are going to exercise your right. It doesn't matter how the price of the underlying asset behave in the past. But options, now we are going to discuss some of the options the price behavior in the history will have an impact on the option. So the first one is the look back option. So in the time, say it's a 3-month option. After 3 months, now you look back. What happens from time 0 to time 3 months? What happens to the price? Price might have gone up, down, something like this. During 3 months period, this is the price movement. You look back and decide the strike price. To decide the strike price depending on the historical price movement. For a call option, you can buy asset at the lowest price. Whatever the price here, irrespective of that. So there's no strike price for the look back option. The strike price becomes the lowest price. So if the lowest price recorded today on the expiry date, you can buy at that market price. If it is higher than that, still you can buy at the lowest price. On the other hand, for a put option buyer, you can sell it at the highest price, I suppose here. You can sell at the highest price. That is a look back option. So the strike price is not decided at the beginning. Strike price is decided at the end of the option period on the expiry date by looking at backward price movement. For a call option, you can buy at the lowest price. For a put option, you can sell it at the highest price. Is it clear? Then there's another one called Asian option. In the Asian option,
Yes, in that, hello? Sir,
yes,
in the look back option, that premium should be very high.
yes, definitely.
And the buyer not going to lose. No? He is not going to lose. No?
Yes, he can buy at the lowest price. If today is the lowest recorded price, you can buy at today's price. So in that sense, he is going to lose the premium.
Okay.
There's no advantage on that. So in the Asian option, again, price might have moved up and down. How to decide the strike price? It is the average price of the asset over the period. So daily you record the prices and calculate the average. Maybe somewhere here. Average price. So this would become the strike price. So if this is the strike price and the market price is above that average, you will exercise your right for a call option. If not, you won't exercise your right. For a put option, if the market price is lower than the average price, you will exercise your right. Even in this case, premium would be high because you get more flexibility. So remember, in the look back option and Asian option, strike excess decided on maturity, not at the time that you entered into the contract. The strike price is decided on the maturity date. Then the other one is the barrier option. This is, so even though you enter into the agreement, whether that agreement becomes effective or not depends on the price movement. Say at the beginning, spot price is 70. Your strike is say 100. There will be another rate, say knock in or knock out rate. That's the barrier rate. Whether the market is traded at this rate or above or below, whatever, decide whether your option is effective or not. For example, assume a call option. You entered into the call option when the spot price is 70, strike with a strike of 100. But on the expiry date, to become this call option effective during the time period, whatever the underlying asset should have traded on or above 110 at least one time. Price goes up from 70 to 110, comes down. This is 110 level. Then only the option becomes effective. If it never reaches 110, somewhere here, it may be 109 on expiry date, but never traded above 110. You cannot make any claim, even though strike is at 100, because this knocked in event has not happened. So that is the nature of barrier option. There can be rules to consider as knocked out. So instead of you are saying your option is effective only if price goes above 110, you can say, okay, option is effective from today, but if the price traded above 110 at any point of time, then your option becomes invalid. So knock out, that is also possible. So whenever the market is traded at a particular level, your option would become effective or would be expired or lapse. That is knocked in or knocked out. Whatever can happen depending on your agreement. That sort of options we call barrier options, but not there are conditions knocked in and knocked out in a same option. Either there can be knocked in one or a knocked out one generally. But if you, yes, even if you want, you can put two price ranges, knocked in and knocked out. So then the binary option, this is on the payoff, not on the strike or the effectiveness of the option. This is about the payoff. Binary. What does it mean? Binary or digital? We have only two values, either 1 or 0. So in a binary option, what does it mean? Either it pays a fixed amount or nothing. That's what. What do you get on the expiry date? It can be a fixed amount or 0. That is a binary option. It's not the difference between strike and the market price. Even in a call option or a put option, what do you get? The difference between, as a buyer, difference between spot and strike. That's what you get. For a call option, if spot increases, your payoff increases. For a put option, if spot decreases, your payoff increases. But it's not the case in a binary option. Market is above the strike, you get maybe a $1, but you get a fixed amount. It can be $10, but still you get the same fixed amount. It does not depend on the market price, on the or the difference between market price and the strike price on the maturity date. If it is above the strike for a call option, you get a fixed amount. If it is below the strike for a put option, still you get the fixed amount. The amount is agreed at the beginning. That's why it's say binary option. Either you pay something or not. The amount is fixed. What is the amount that you pay? That's a binary option. So then the last one, it's a Bermudian option. This depends on the timing.
Sir, yes, excuse me, sir.
Yes.
In binary option, is there an option where nothing is paid at all?
Yes. It
Again,
fixed amount or nothing.
nothing means.
It means it's like if the option expired, say call option, spot price is below the strike, you don't get anything. That can happen.
Only the maximum amount is there, no? Only the maximum or minimum. That minimum is 0.
Not the maximum. This is the fixed amount. That's the one and only amount, fixed amount that you get.
Yeah, maximum amount is fixed, no?
Not the maximum amount. Whatever the amount that you get is fixed. When you say it's the maximum amount, there's an opportunity that you may get below that. It's not the case. Either you get $1,000 or 0. Something like that. You don't get 500. When you say fixed, it's fixed. The amount is given. That's the amount that you are going to get. Not less than, but or 0.
That amount, fixed amount is have conditions also, no? That means it should go above this amount.
Yeah, that depends on whether it's a call option or a put option. If it is a call option, price of the underlying asset should be above the strike price to get this fixed amount, or else you get nothing. Is it clear?
Okay. Okay.
So Bermudian option falls in between American and European. Why? In the American option, you can exercise any time. If you say T, any time you can exercise. In the European style, only on the maturity. European style allows you to exercise your right only on the maturity. American style, you can do it anytime. But the Bermudian, what they do, so it's in between America and Europe, no, Bermuda. So they decide sometimes, maybe every month or something like that. Certain dates are fixed. On any of these dates, they can, or the buyer can exercise the right, not in between these, either here or here or here, likewise. But in American, anytime it's continuous, anytime you can exercise your right. Basically any day. But in a Bermudian, not any day, but given on given days. It's more than one. In the European, only on the maturity date, last date of the contract. So that's the difference between American, European, and Bermudian option. So this is about the, again, it's not about strike price timing. It's about timing. When you can exercise your right. Any questions on those?
So that means it can be any timing, no?
No.
Any fixed
dates are
timing.
specified. When you enter into the contract, what are the dates that you can exercise your right is given. Not any time. When you say any time, say if it is a 3-month option, within 3 months, any day you can exercise your right. That's the American style. In the European style, you can do only on the mature expiry date after 3 months exactly. But in a Bermudian, there are specified dates in between origin to expiry. There are specified dates given. On one of these dates, you can exercise your right.
Okay, sir. Thank you.
Is it clear?
Yes, sir.
Okay. So see what I understood is, so when you say maximum or fixed, or any, so you should be able to distinguish these. When you say any time or any amount, there's no restriction. When you say fixed, the amount or the date or whatever is specified. You cannot go away from that. When you say maximum or minimum, so the payment or the timing, whatever can vary, but cannot go beyond this if it is a maximum. If it is a minimum, that can vary, but cannot go below that minimum. But when you say fixed, it cannot be vary. It's a fixed amount. So be clear on those things. Okay, any questions? Any other question?
Sir, can you explain that knocked out again?
Knockout. So that means, so carrier option, what I explain here, say call option, at the time of entering into the contract, spot price is 70, strike price is 100. So there can be a knockout rule the price is 110. What does it mean? So say 3-month option, call option with a strike of 100. So generally what happens, irrespective of the market price movements, on the expiry date, assuming it's a European style, on the expiry date, if the spot price is higher than 100, this strike, the option buyer can exercise the right. That's the normal plain vanilla option. But in a barrier option, what would happen with a knockout rule? There's a clause saying during this 3-month period, if on a particular day, if the price trade above 110, then this option becomes or considered as expired or ineffective. So even though initially the option is for 3 months period, after 1 month, if the price goes above 110, the moment the underlying asset traded above 110, the option becomes null and void. On the maturity date, whatever the price, whether it's 200 or whatever, it doesn't matter. Buyer of the option cannot make any. So that's a knockout. You were knocked out from the game. That's what happened. In the knocked in one, it's other way around. So as the buyer of the option, you to become eligible for that claim, the market price should trade a particular level. It can be higher level or it can be lower level. There can be a call option with spot is 70 and the strike is 100. The barrier level may be 50. Unless it goes down to 50 and touch it and touch it, you are in a knocked in option. Your option does not become effective. That can happen. That depends on the rule. What is the knocked in or knockout conditions imposed in your contract? Is it clear?
Okay, so that means it should touch up a certain price level, no?
Price level. So once that price level is traded, if it is a knocked in condition, then only your option becomes effective. If it is a knocked out rule, once that level is traded, you are out of the picture. You don't have any option again. That's what happens.
So at that time, do we have to exercise? So can we?
No. No, you
We have
can't.
to
You're knocked out. You're out of the game.
So in case of knocked-in, so can we exercise at that time, or do we have to exercise?
That depends on whether it's a European or an American. If it is a European, you have to wait until the end of the contract or until the expiry. On the expiry date only you can exercise your right. This knocked in and knocked out, what it does decide whether your option contract becomes effective or becomes ineffective. Which was effective already becomes ineffective if it is a knocked out. A contract which was not effective becomes effective if it is a knocked in.
During that period, any day it can happen, no?
Yes,
it
like anything.
only one, it becomes expired. No?
Yes, so maybe the price won't change, trade your knocked in level. So you don't have the right even at the maturity. If it is not traded at that knocked-in level, you are not qualified. You are not
So
qualified.
reaching only once is enough to be knocked in or knocked out, no?
Yes.
During the period.
Again, so this is the basic form. One knocked in and one knocked out. In a particular contract, only one knocked in or a one knocked out. But there can be combinations of those as well. There are double knocked in, double knocked out, and things like that. The same level should be traded 2 times. Then only you consider it's as a knocked in. Oh, same level traded 2 times, then it's knocked out, whatever. There can be combinations or the more complex arrangements. But basically, if it is a knocked in condition, before your option becomes effective, that level should be traded. If it is a knocked out, if that level is traded, your option becomes ineffective, no longer valid. So that's why it says bond can no longer be excised. If it is knocked out, you cannot excise your option, even it is above the strike or below the strike, depending on whether it's a call or a put. Once you knock out from a tournament, it doesn't matter, you don't participate, same thing. Knocked in, like you are going for a qualifying matches. If you meet that restrictions given in a qualifying matches, you don't win the qualifying match, then you are not participating in the tournament. Or in the tournament, you are in the tournament, there's a knocked out match, you lose that match, you are out of the tournament. Same thing.
So excuse me.
Hope it is clear. Yes.
Yeah, are these options we are talking about the types of options? Or?
Yes. Different type of options. The other than the basic options that we discussed earlier, American style and the European style. So these are other styles, different types of options. Most of them path dependent. What is the price movements historically or during the life of the, indeed during the life of the option, what is the price movements? Say look back option, strike price is depend on the price movements during that life period. Asian option also same, because you take the average. In a barrier option, during the lifetime, if the price traded that level, either you knocked in or knocked out. So path dependence. Only the binary option is, you cannot say path dependent. Only difference because that is based on the payoff. Payoff would be a fixed amount or nothing. Either you get $1,000 or zero. Whether your difference between market price and the strike price may be 1,500, still you get only 1,000. It may be just $1, but still you get 1,000. That's the difference in binary option. Whether you get a fixed amount or nothing at all. Bermudian option, again, this is a path dependent, because there are different times, specific times where you can exercise your right. So all these are different type of options. but basically put option and call option. There can be a Bermudian call option. There can be a Bermudian put option. There can be American style, binary put option, binary call option. Barrier call, barrier put. That won't change. Whether what is the right that you get, it will be there. So how to decide strike? That will depend on what is the type of the option that you call. When you can exercise it, you're right. That depends. Whether it's American option or Asian or a European option or a Bermudian option. But in an Asian option, how do you decide the strike price? Even the look back option, how do you decide the strike price? That's how these things changes. Any other question?
So in binary option, there can be conditions, no? To get this fixed amount, you should price should pass this like that.
No, that's what I mentioned. Binary option, it can be a call or put. That condition is there. That's the basic. Not only binary, even in the Bermudian, even in the in the look back condition is just the get the minimum or the maximum price depending on whether it's a put or a call. Likewise, that basic remains same.
That means to earn a fixed amount, there may be some other conditions. Just asking.
What do you mean other conditions?
So should go this amount below above this amount.
No, that's the condition of call or a put.
So that means without any condition that binary option can be applied. That means anyway you will be the fixed amount will be.
No. How comes? If you buy a call option, what is the condition that you have to meet? When do you get a payoff? If it is a call option, you are a buyer. When do you get a payoff? What is the condition that you have to meet? Spot price should be higher than the strike. Otherwise, you won't get. What you get is the difference between spot and strike. That can be varied. In a normal call option, the difference between strike and spot varies. So depending on that, your payoff varies. But in a fixed binary option, yes. In a binary option, that amount is fixed. If the price remains above the strike, you get that fixed amount. It doesn't depend on the difference between spot and strike. But it has to be above the strike price. Whether it's just a buy a cent or whether it's buy $1,000 or $10,000, it doesn't matter. You get that fixed amount.
Okay, sir. Okay.
Is it clear now?
Yes, sir.
Yes. Don't forget about the basics. As I mentioned, any type of these option should fall into either to call or a put. Then whatever the conditions in put option or a call option are applicable. Okay, we'll move into options on futures. Okay, just 2 slides, then we can have the break. Option on futures is, say, in this option is an option. Only difference is the underlying asset is a futures contract. So underlying is a futures contract, not a plain vanilla asset like a foreign exchange or a commodity or interest rate, not like that. This is a futures contract. So future itself has another underlying. So option on a futures contract. So then what does it give you? If you're a buyer of an option, say call option, what is the right you get? If you buy a call option on futures, what is the right you get? You get a right to buy the futures contract. You get the right to buy the futures contract. If it is a put option, you will get a right to sell the futures contract on whatever the underlying asset. Is it clear? You don't sell or buy the underlying asset. That means the real underlying asset. Instead, you buy or sell a futures contract on that underlying asset. So this is an example. An investor purchased a call option. So it's a call option on June Euribor futures. What is a Euribor futures? It is interest rate on euro. So that's the option, interest rate option that the investor has purchased to buy the futures contract. So on the expiry date, he will check its strike price and the futures price. If the futures price is higher than the strike price, he will execute his right and buy the futures contract on Euribor to be matured in June. So in that case, then the option buyer would become a long party to the futures contract, same as option seller would become a short party to the futures contract. But only thing here is the maturity of the option cannot go beyond the maturity of the expiry. So you cannot have an option on June Euribor maturing in July. That cannot happen because your future is expired in June. So therefore, expiry of the option should be less than the expiry of the futures contract. That's the condition that you have to meet when you do options on futures transactions. Only thing is, remember, what is the right that you get if it is a call option to buy the futures contract that you agreed. If it is a put option to sell the futures contract that you agreed. Once you buy the future or once you sell the future, then you are exposed to the futures market. All the things that we discuss in futures will be applicable. Only on the expiry of the futures contract, you can buy the underlying or you can sell the underlying asset. Is it clear? So this is a derivative on derivative.
So you're paying a premium to lock on the price of that future.
Yes.
Right?
Yes.
Okay. So the benefit of this would be if the future price is too volatile, is it? Like you can straightforward like go and buy the future instead of doing this. What is the benefit there? Like
yes, if you buy a futures, what you have to do is to just to keep the margin. Here, if you buy the option on the future, you have to pay the premium. It's a premium. There's a cost. You have to evaluate that cost benefit and see why do you do this. Especially that can happen if you think volatility is going to go up. Then the option price may change in future. Option price may go up. Things like that. Yes.
Okay. Yeah.
There can be conditions. So you have not arranged a broker to do futures and things like that. If still you want to get the exposure to futures, and
So by
not only that. So why do you buy an option instead of buying the future?
yeah,
You
you don't have
keep
this
the
obligation. Yeah.
you don't have the obligation. You keep your downside open.
But you still have the your portfolio still has the exposure to that future.
Futures, yes, yes. Not exactly on only on one side. Like say you buy a call option on futures.
Yeah.
If the price goes up, you make a profit. If price goes down of the futures, your loss is limited to the premium that you paid.
But when
Then your
you
downside is protected.
right, but when you purchase this option, you can either in any way you can exercise this even at a loss. So that would like I mean
No,
without even
at a loss. So what do you mean by at a loss? You don't
no,
express. You
yeah,
don't.
I understand. I'm just saying that the exposure on the exposure perspective, even at a
Yes,
loss, even you have the access, right?
you get the exposure to the futures, but only to the upside only. Say you buy a call option,
Yeah.
you make a profit if futures price goes up.
Okay.
If futures price goes down, you don't make a loss other than the premium that you paid.
Okay. Yeah. Yeah.
So that's the basic concept of buying an option, even not only for futures, even in other commodities. If you buy a call option, you take the upside, but you don't take the downside of it. If you buy a put option, if the price
So
goes down,
you unless you exercise this, you can't like account for these changes in the future price, right?
unless you
Exercise the option.
no, even you don't exercise your option, if futures price goes up, definitely your value of the option also increases.
Okay.
So however, on the expiry date, you will get that gain.
Yeah. Yeah.
But if it has gone down, futures price has gone down, you book only your premium as a loss.
Premium as a loss. Okay.
But if you have bought the futures contract,
Then you have to mark to market
you have to
that
mark to
loss.
market and book the whole loss.
Entire loss. Yes.
Entire
Yes.
loss, yes. That's the difference of doing option.
So that's less risky and more
It's not
profitable.
only on the future on the futures. Any underlying,
Yeah.
that's the thing.
Okay.
Okay, anything else?
So in a Euribo, that means that is protection against volatility in the market. It's cost.
No, Euribo, it's the interest rate. So it's the interest rate option. If the interest rate increases, futures contract will go down. If interest rates decreases, futures price goes up. That is, it's like borrowing or lending in the future, not today. You trade Euribo based on the views on the or whatever the interest rate futures, not only Euribo, whatever the underlying. You trade interest rate futures based on your view on the interest rate movements. If you can remember, I just mentioned how to price the interest rate futures. It is 100 minus the index value. Index value means the reference interest rate. If interest rate increases, 100 minus high figure means you get a lower price. It's similar to a bond. If the interest rate increases, future price goes down. If interest rate decreases, futures prices goes up. Interest rate futures price goes up. So depending on that, you buy or sell futures. If you think interest rates to go down, you buy futures. If you think interest rates to go up, you sell futures.
Okay, sir. Thank you.
Okay. Anything else? If not, shall we take a break here and come back on and start the other handout options too. It's about basically about pricing of options. We are not going to do pricing, but what are the factors that have an impact on option prices? That's what we are going to discuss. So we'll take a small break now. It's 11 o'clock. We'll come back in 11:15, around 11:15.
So excuse me.
Yes.
In the last presentation, I have a question. Can you go?
Yeah.
பார்க்குறீங்க கனெக்ட் பண்ணி விட்டுட்டு
Yes, tell me what's your question.
Yeah, the last presentation, last page of the presentation.
Last page.
Last page. Yeah, on exercise option seller would be what do you mean by that, sir? On exercise option seller, the last
On exercise of so here on exercise of the option. So if the buyer of the option exercise his right, that means buyer of the option, because it's a call option no, here in this example. Is it clear? This is a call option on the Euribor future. So if the buyer exercise his right, what would happen? The buyer of the option will buy the futures contract. Is it clear? If the option is exercised by the buyer, option buyer, the option buyer will buy the futures contract on Euribor. Is it clear?
Yes, sir. It's clear.
Okay. Then what would happen to the seller of the option? He is selling a futures contract to the buyer of the option. So that's why it says the seller would be assigned a short futures contract. When the on exercise of the option, buyer will buy the futures contract and seller will sell the futures contract. Seller of the option will sell the futures contracts also. Therefore, the seller of the option contract will be assigned a short futures contract, while the buyer of the option will assign a long futures contract.
Okay, got it, sir. Thank you.
Okay, thanks.
Yes.
Anything else?
That is not the underlying security. We are talking about the futures contract.
Because okay, now here there are two underlines. What is the derivative? First derivative we have. This is the first one. What is the underline for the option? Is the futures. Correct? underline for the option is the futures, but for futures there can be another underline. So on the option contract, the underline is future. So since it's a call option, he will buy the buyer of the call option. If he exercises right, he will buy the futures contract. Whenever he buy a futures contract, he is agreeing to buy the underlying asset. Is it clear?
Yes, sir.
So that's what happened. Is it clear now?
Yes, got it, sir.
Okay. Oh, thanks. Anything else? Okay, to make this little bit clear, since the futures contract is June expiry, say assume this is April, this may be somewhere in March. The buyer of the option enters into this option transaction in March with the expiry of 1 month. Okay. So on the expiry date of the option contract is only up to this period. On the expiry date of the option, the option buyer, call option buyer, decide whether to buy the futures maturing in this, whether to buy this future or not. On this date, the option buyer will decide it. How? If the strike price is less than the futures price, market futures price, he will exercise his right and buy the futures contract at price X. Then from April to June, he holds this futures contract unless he sold it. That's what happened. Anything else? Shall I move into the this?
Okay, sir.
Okay. Yeah, these are the things we are going to discuss. Let's see whether we really need to discuss last two topics, but premium, determinants of the premium, and put call parity. This is sort of in options where we have the no arbitrage theory. It reflected in put call parity, and we'll try to discuss these things. If time permits, we'll move ahead. So this is again a summary on options, what we discussed. Option buyer has the right either to buy or either to sell the underlying asset, depending on whether it's a call option or a put option. Whatever it is, option seller has the obligation to meet the buyer's right. Then the option seller requires compensation for the risk that the option seller takes. So if you remember, option seller takes a huge risk, basically theoretically unlimited risk. So to take that risk, he should be compensated. That compensation is the premium. Just to collect this premium, he takes that risk in other way. That's what it does. So the premium is the buyer pays to the seller just to compensate the risk of the seller. And the premium is unrecoverable. So that means once buyer paid the premium, it cannot be reversed. So that is the price of the option. To buy the option, the buyer pays that price. It is the premium. And the price, that premium is decided by the buyers and sellers in the market, depending on the demand and other factors. So we are going to discuss those factors. That cost is decided by the buyers and sellers, not someone else. So as I mentioned, option buyers pay that agreed premium to the option sellers, and it's non-returnable. The two key factors which have impact on the premium of any option is the strike price and the time to expiry. Not only these, there are some other factors. We'll come to that later, but initially better to have the understanding on the impact of strike price on the premium and time to expiry on the premium. So this is an example. Whatever the underlying asset, it doesn't matter. Different strike prices for call options: 500, 525, 550, 575, 600. Strike price goes up, and the premium for March expiry, premium for April expiry. So that means premium for a call option with a strike of 500, premium for the March expiry is 70. Premium for April expiry is 85. Just 1 month extension, you can see 15, difference of 15 there. And you can see for the same strike, but two different maturities, longer the maturity, higher the premium. Even in the next one, you can see the same relationship, 49 to 61. The premium increases. 37, 46. Premium increases from March expiry to April expiry. 25, 39, 19, 28. You can see when the expiry increases, time to expiry increases, premium increases. But if you go down on one of these columns, you can see premium decreases. Why? Strike price of a call option increases: 500, 525, 550, 575, 600. So when the strike price increases, premium decreases. So basically, you can see the same pattern here. Strike price increases for call option, premium decreases. So basically, call option increases, premium decreases. That's what happened. You can see in this example. Okay, the thing is why I can put any numbers and tell you, okay, this is what happening. It's not why. What is the reason? For a call option, when the strike price increases, premium decreases. What's the reason? Can someone?
Probability of that price going higher would be less, right?
Yes.
The risk of
So what would happen if, say, if I draw a line here, this is the current spot price, it's not, this is X1, this is X2, likewise. What would happen for a call option if price goes above somewhere here? What would happen? If the spot price increases, if spot price increases above the strike price, what would happen? Buyer will exercise his right, and this difference may be the loss to the call option seller. That's what would happen. So there's a value for this option if the price goes up above X1. X2 is much higher strike price. Say for a same time period, within a 1 month period, what are the chances of price going up X1 or going above X1 or going above X2? What are the chances? The chances of spot price trading above X1, which is closer to the current spot price, is high compared to the chance of the spot price going above X2. So the risk is high in this one compared to the second option. So when the strike price increases, like here, chances of option getting exercise is low. Or on the other hand, chances of spot price trading above this strike price is low. Therefore, premium goes down. But on the other hand, when you think about timing, where do you see the most uncertainty? In the near expiry or the longer expiry?
Long expiry.
Long expiry, the chances are high. Price can deviate from the current level by a large amount. So the risk is high. When the time to maturity increases, risk is high. So therefore, premium increases 70 to 85. That's the concept behind this. So remember, for call option, I emphasize that for call option, higher the strike, lower the premium. For call options, higher the strike, lower the premium, because of the chances of trading the underlying asset at or above high strike prices are low. That's one thing. So on the other hand, we can say when the time to expiry increases, premium increases. We'll see in coming examples whether that is true for the call options and put options as well. We'll see. Okay, what would happen for put options? Put options, what would happen when the strike price increases? What would happen to the premium?
it'll get higher, right? Because the chances of exercising it would be higher. I mean, doesn't get a better price, right?
So now we have to think about spot price somewhere here. It's not to make it clear. I keep X2 as the higher strike price, X1 as the lower strike price. X1 is less than X2. Okay. Now tell me what would happen when strike price increases for a put option. When do you exercise the put option if you are a buyer? When do you exercise your put option if you are a buyer of the put option?
When the strike is low, sir.
When the strike is low. In a put option, strike is fixed. For a particular option, strike is for a particular
compared to the market price.
Uh-huh.
When the strike price is low, we will exercise.
So in this case, say even on the maturity date, if the spot price is S0 and your strike is X2, do you exercise your put option? That's the key. So by now you should know when to exercise your call option and when to exercise your put option. What is the right that you get when you buy a put option?
Right to sell.
Right to sell. So would you like to sell it at a higher price or a lower price?
Higher price.
Higher price. So this is your strike price. Forget about this X1 for the time being. This is your strike price of an option. This is the current market price. Is not. What do you do?
You do not exercise.
You don't exercise.
Exercise.
For you to exercise your put option, the price should be below the strike. So if the price goes down somewhere here, you exercise your right. The price should be lower than the strike for you to exercise your put option. So now tell me what would happen to the premium when the strike price increases. What are the chances of exercising a put option with a strike X2 and strike X1? Which option with a strike X2 or with a strike X1 should have the high premium? Which one is more likely to exercise?
X1.
With a strike of X1.
Yes.
Why?
The difference is high between
Difference of what high?
X1 and strike price.
X1 is the strike price.
No, spot price.
Which spot price? Is not.
S0.
So again, S0 is 100, X1 90, X2 90, X1 80. On the expiry, say after 1 month time, say assume it's 1 month option. If the price is 85, what do? This is the spot price. After 1 month, spot price is S1. 100 is at the time of you enter into the put option. After 1 month, spot price is 85. What do? You have bought a put option with strike 90.
You exercise.
So you exercise. Indeed, it should be. $85 somewhere here. You exercise the put option with a strike of 90 because now you can sell it at 90 whereas the market is at 85. What do you do with the put option with a strike of 80?
Will not exercise.
You exercise.
Huh?
Exercise.
You exercise. Why?
Because market. No, sorry, not exercise. Market
don't?
is cheap.
Means you can sell at a higher price than the
At the
strike
market.
price. At the market, you can sell it at 85, whereas your strike is 80. So you sell it at market price. So then which option is having more value? This one with a strike of X2 or with a strike of X1?
X1.
X1. X1 have a more value. Why?
So we can select 90 market price.
No, X1 is this one.
So
This is X2. I remember X1 is less than X2.
X2.
So the option with a strike of 90 is more value than the option with a strike of 80. So basically what would happen when the strike increases, value of the put option also increases because it gives you a right to sell at a higher price. The buyer will get a chance to sell at a higher price. So this is your selling price basically, underlying asset. You can sell it at X. Higher the rate, better. So therefore, higher the premium. Is it clear? So first of all, you should be able to clearly identify when to exercise your option, when to exercise your call option, when to exercise your put option. That has to be clear by now. Okay, what is the right that you get when you have a call option? What's the right you get when you have a put option? Then when do you exercise your right? That has to be clear. Okay, so basically these two relationships are true. For a call option, strike price increases premium decreases. For a put option, strike price increases, premium also increases. Okay, that's the relationship. So not only that, you can see with the time to maturity, there's a difference in price as well. When the time to maturity increases, price also increases. So therefore, premium of an option has two components. One we call the intrinsic value. Other part we call the time value. First thing we call the intrinsic value. Second part we call the time value. Because of time to maturity, there's uncertainty in the market, whether prices going up or down, whatever the volatility, that will give a value to the option. That part we call time value. The difference between the spot price and the strike price, that will be reflected in the intrinsic value. This is true any time of the during any time of the contract, not only on the expiry date. In the expiry date, indeed time value is 0 because no time to maturity. So then we'll discuss how to find this intrinsic value and how to find out time value. So intrinsic value, as I mentioned, it's the difference between the strike and the underlying assets price, and that can never be negative. Intrinsic value, that cannot be negative any time. Even though we call it as the difference between the strike price and the underlying asset price, it cannot be negative, never. So therefore we write the intrinsic value for a call option is as the maximum value of spot minus X or 0. What is the reason? So call option, assume this is the strike price. This is spot 1, spot price 2, spot price 3. If the market spot price remains at S1 on the expiry date or any time, is there any gain to the call option buyer on this? Just on this because of price difference? Forget about the uncertainty into the future. Say assume a European option, American option. Anytime you can exercise. Okay, now today spot price is S1, whereas the strike price is X. This is a call option. Will you exercise your right? Will you exercise your right? When the spot price is S1, which is lower than the strike price?
No.
No. Will you get anything therefore, any cash flow as a buyer?
No.
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 It would be 0. Forget about the premium that you paid. Okay, what would happen when the price is at S2? That is also 0. Whether you exercise or not, you can exercise if you want. Still you get a 0 value. You don't get anything additional. But when the strike price, when the spot price is at S3, will you exercise your right? Call option?
Yes.
Yes. What is the payoff? It is this difference. What is that? S3 minus X. Correct? All other instances, payoff is 0. When the spot price is above the strike price, payoff is spot minus X. That is what given here. If this difference is positive, you get that figure. If that difference is negative, you get 0. So the intrinsic value of a call option is given by this. Is it clear?
So this is a spot future price or the current price?
Spot, current, spot. At whatever the time that you are trying to exercise, at that point, that is the spot price, not a future price.
Okay. Okay.
Okay, what would happen to a put option then? This is the strike. This is spot price 1, spot price 2, spot price 3. If the spot price is higher than the strike price, what do you do with your put option? You don't exercise. So your payoff is 0. When the strike equals to spot price, either you can exercise or you can let it expire, but still the payoff is 0. What would happen when the spot price is less than the strike price? You exercise your right and your payoff would be the difference between these two. So to get a positive figure, it should be X minus S3. So that's what given here. Either you get the strike minus spot or 0. It never be negative. Your payoff will not be negative. Is it clear? Is it clear? What is this intrinsic value and how do we get this?
Payoff can't be negative. Does that mean you can't make a loss?
You can make a loss because the premium is paid.
Okay.
In the payoff, we don't consider the premium.
Right.
What is the outcome of the option itself?
Okay.
Exercising or not exercising. Okay, that's how we get the intrinsic value. So for you to exercise your option, there should be some positive intrinsic value. Otherwise, you won't exercise your option. If it is 0, you don't do that. So all options that have intrinsic value at expiry will be exercised, should be exercised. But if you miss something, it's your fault. That has to be exercised. Options with zero intrinsic value, it's not worth to exercise in at expiry. But here thing is, if the spot and strike same, zero intrinsic, whether you exercise it or not, there won't be any addition. But you should not exercise if it is on the other side. However, if the intrinsic value is positive, you should exercise your right. As we discussed, premium is not refundable. So therefore, amount paid for the option is not a factor in determining whether to exercise or not. I mentioned this even in the previous session. So to take the decision whether to option should be exercised or not, we don't consider the premium paid. It's already paid. So therefore, we don't consider that as one of the factors to decide whether the option should be exercised or not. Only concern here to decide whether option is exercised or not, should be exercised or not, it should be the intrinsic value, whether the option has a positive intrinsic value or zero intrinsic value. So once you exercise your right, you will realize the intrinsic value. Then offset that intrinsic value against the cost, that is the premium, to calculate profit or loss. So what we discussed in the previous one, how do we whether it's a profit or loss. Now depending on that intrinsic value, we categorize any option into three different categories: in the money, at the money, and out of the money. So there can be options which are in the money or at the money or out of the money. We'll go through one by one and I try to understand what are those, what is in the money, what is at the money, or what is out of the money. So again, the conditions vary, depends on whether it's a call option or a put option. So here I am going to discuss moneyness, whether that means whether the option is in the money, at the money, or out of the money for a call option. What does it mean? Strike price is less than market spot price. Strike here, spot here. At the time of expiry or at the time of you exercise your option, because American option you can exercise it at any time. So at the time of exercise, if for a call option, if the spot price is higher than the strike price, your intrinsic value is positive. S minus X is positive. So you should exercise your option. So this is the case where we call in the money, where you have the positive intrinsic value. That means spot price here, strike price is less than the spot price. For a call option, when the strike price is less than the spot price, option buyer will exercise the right, and that option has a positive intrinsic value. The intrinsic value equals to S minus X in this instance. That type of option we call in the money. Whenever the S minus X is positive for a call option, we call it a in the money option. We call the option is at the money when the strike price and the market spot price are same. So X and S remains here. Both are same. x equals s. Intrinsic value is 0, but any moment the option can be fall into in the money, that means positive intrinsic value or a negative value, or still remains in the 0 intrinsic value. So that is the condition that we call the option is at the money. So it's about to go into in the money. That happens when the strike price and the spot price equals. So for a call option, the fourth option, third condition is when the spot price is somewhere here, lower than the strike. Strike is higher than the spot. There's no value for this option, so intrinsic value is 0. We call it as the out of the money option. Is it clear? This one in the money is easy. Whenever the intrinsic value is positive, it is in the money. But at the money and out of the money, intrinsic value 0. But in this case, if you calculate s minus x, this would be 0. In the out of the money, if you calculate s minus x, it would be negative. But in the intrinsic value, we don't consider this negative figure. We consider 0 because you are not going to exercise this option. If you exercise your option, you will get a negative flow. That's how we categorize in the money, at the money, and out of the money for a call option. Now you can think, what are the conditions for a put option to be categorized as in the money, at the money, and out of the money? For a put option, when do you categorize as in the money? What should be the relationship between s minus s and x? At the money, what is the relationship between s and x? Out of the money, what is the relationship for a put option? To become in the money, should the exercise price higher or the spot price be higher?
So when the strike is higher than the spot price, it is in the money.
Yes, when the strike is higher than the spot price, it is in the money. And this is the time that you are going to exercise your put option, because you can sell at a higher price than the market price. At the money, whether it's a put or call, when strike equals spot, then the option is at the money. For a put option, out of the money is the opposite of this. When the s greater than x. So here x minus s positive. Here x minus s is 0. Here x minus s is negative. But if this happens, this is out of the money. But in the intrinsic value, we don't consider negative figures. We consider only the 0 because we get the maximum of x minus s or the 0 because we don't exercise when we meet these conditions. So therefore there's no payoff. We don't have negative payoff through any option. We don't get any negative payoff from a option because we don't exercise when it is not in our favor. We don't exercise our right when the option is not in our favor. So this is again a graphical representation for a call option. What is in the money and what is out of the money. The strike price goes, spot price from left to right increases. When the market price is higher than the strike price, the option is in the money. When the market price is lower than the strike price, the option is out of the money. When the strike price exactly equal to the market price, then the option is at the money. So we can draw same thing for a put option. So these are the conditions that we discussed for put option. Put option will be in the money when the strike price is higher than the market spot price, then there will be a positive intrinsic value. Strike price equals to the spot price, intrinsic value 0, and the option is at the money. Strike price is lower than the market price, you don't exercise, so out of the money, and intrinsic value is 0. So you can see the same picture but in the reverse side. Left hand side would be in the money, right hand side would be out of the money for a put option. When the strike price is less than, when the market price is less than the strike price, put option is in the money. When the market price is higher than the strike price, put option is out of the money, and strike equals to the spot price, option is at the money. So now we discuss about intrinsic value, and based on that intrinsic value we discuss at the money, out of the money, and in the money conditions. So to calculate the premium and to calculate the time value, how do? We take the premium and deduct the intrinsic value. To calculate the premium itself or entire premium, there are different models. Either we have to use BSM model, Black-Scholes model, or we can use there are many ways. There's another method called binary tree method. So both methods are out of scope here. It would be too much for you. So we are not going to discuss any of these methods. So based on these methods, we calculate the premium. Once we calculate the premium, we can easily calculate the intrinsic value and deduct that to get the time value. So only thing is you have to identify, you should be able to identify what is the intrinsic value, what is the time value. And remember, intrinsic value never be negative. It is always 0 or positive. Never be negative doesn't mean always positive. It can be 0 as well. So as I explained earlier, the time value of the premium reflect the compensation for the uncertainty for the option seller that he faced during the rest of the lifetime of the option contract. with the time, market prices can move up and down, and it can make a risk to the option seller. To compensate that risk, the time premium is paid. So if you compare this table, you can see that relationship. Strike price increasing, premium of the call option, premium on the put option, then the intrinsic value and the time value. When the premium is 70, intrinsic value is 50, time value is 20. So what happens when the strike price increases, premium decreases for all options, and you can see intrinsic value also decreases because market price remains below these strike prices. So therefore no intrinsic value, but still there can be a time value. On the other hand, for the put options, when the strike price are low, intrinsic value are 0, and when the strike prices are high, intrinsic values are positive. Then the time value. So intrinsic value plus the time value gives you the premium for the option. So you can see time value increases and then decreases. Even here, time value increases, then decreases. There are reasons for that as well. So we'll do few examples to understand how to distinguish between time value and intrinsic value. So this is an example. On the newspaper on 15th March 2020 reported the following information on a May 2020 call option on shares of ABC company. So this is March. We are here. Options to be expire in May. Price of the call option is 35.75. What does it mean? Premium is Premium is 30.75. Strike price X is 66. Spot price 80.75. As of 15th March, spot price is 80.75. It's a call option. Tell me whether this option is in the money, out of the money, or at the money. Tell me whether the strike or whether this option, this call option, is in the money, out of the money, or at the money.
It's
It
in the
is
money
in the money. Why?
because the spot price is higher than the strike price.
The spot price is higher than the strike price. You have a positive intrinsic value. So it is in the money. What is the intrinsic value? How do you calculate the intrinsic value for a call option?
So spot minus strike.
Spot minus strike. Remember, if it is positive only. If it is negative, intrinsic value is 0. So here we can see it is positive. 80.75 minus 66. So it is 14.75. So the intrinsic value is 14.75. Then the premium is 35.75. What is the difference? 21. What is that 21?
So that is the
That
time
is
value.
the time value. So we are in March. The option is expiring in 2 months. So still there's uncertainty. The price can go up and down. So the chances of ending up much higher price of spot is high. That uncertainty is there. So therefore, time value is high, 21. So that's how you calculate intrinsic value and the time value given the total premium. So intrinsic value is equal to spot price minus strike price when the option is in the money. Remember, this is not true for every time, all time. This is only if it is positive. So you get the intrinsic value of 1475. Then the time value is, this is true all time. Time value is option price minus intrinsic value. Time value is 21. Okay, tell me, in this example, if the strike price of the call option is 6 years, spot price 80.75. Instead of this 80.75, if the spot price was say 55, what is the intrinsic value? What is the time value? If the spot price was 55, not 8.75, what is the intrinsic value of this option? What is the time value of this option?
Intrinsically 0.
Sorry?
Intrinsically
Intrinsic value is
It would be 0, right?
yes. Intrinsic value is 0. Why? Whether the option is in the money or out of the money or at the money?
This is out of the money because
This is out of the money because strike price is higher than the spot price. For a call option, when the strike price is higher than the spot price, there's no value for exercising this option. So it's out of the money. When the option is out of the money, intrinsic value is 0. Then what is time value?
35.
35,
75.
75. So for out of the money and at the money options, still there will be a premium. That premium equals to the time value of the money. There's no intrinsic value, but there's a time value.
So is that because the spot price can change in favor?
Yes. In the future, we never know what would happen to the spot price.
Okay.
Is it clear? this is on a put option. You can try this. So this is the premium. Put option on XYZ was 70. Strike spot is it in the money, at the money, or out of the money? This is a put option, remember.
So that is in the money, sir.
It's in the money. Why? Strike price is 378, whereas the spot price is 310. What does it mean? You can sell the shares at 378 when the market is at 310. Then what is the intrinsic value? For a put option, it will be X minus S if it is positive. So 378 minus 310, which is equal to 68. Intrinsic value is 68. What's the time value?
$2, sir.
Just $2. 70 minus 68. Okay, now if we go back to the now you can see for the same, almost same maturity, March to May, the time value of the call option is much higher, 35, but in this time value is just 2. Why is that? The reason is when the strike here 378, now the spot is somewhere here 310. This distance the market consider it's a large to normal price volatility of these shares. What is the daily movement? This is far away from the strike. So even within the next 2 months, the market is priced in such a way, the chances of this is coming back to this is low, because the intrinsic value is very high. So even this change by small amount, that will drive the premium, not the time value. So we call this sort of options as deep in the money. That means far away from the strike. That can be a put option or a call option. If it is other way around, in a call option, if the strike is here and the spot is far away, say 100 and 180 or something like that, that depends on the daily price movements and things. This is a relative thing. whether difference of 80 is far away or not, that depends on the market movements or the price volatility. However, if we can think this is a substantial deviation from the strike price, then we can say this is a deep in the money option. It can be a put or it can be a call. If the price is far away and towards the in the money side, then we call it a deep in the money option. That can happen for the other side as well. It is deep out of the money. So again, the whatever the time period, chance that the price can come back to and bring the option into the in the money status. So that sort of options, time value plays a less role compared to the intrinsic value. That's why here you can see time value is very small too, but in the previous case for the same, time value is high. Not that's only one component, but that depends on the volatility of the prices of the underlying asset as well. Market nature will have an impact on the option pricing. Any questions? If you don't have any questions,
when the payoff is hello.
yes.
So when the payoff is positive, that is the intrinsic value, no sir?
What about when the intrinsic payoff is negative? What is the intrinsic value?
So there is no, it's not a intrinsic value, no sir?
Intrinsic value is zero.
Zero. Yeah. Okay.
Zero.
Okay, sir.
There's a difference. Zero, positive value, and a negative value. So we don't have intrinsic values of or negative intrinsic value. It can be either zero or positive. If you think no intrinsic value means zero, that's fine. Yes.
Okay, sir.
So this piece means that is more volatile, in the sense price volatility is high.
I didn't hear the question properly.
The deep means it is more volatile. The prices are more volatile.
Can you repeat the question first part? I didn't hear that.
Deep means here you mentioned deep. Yeah.
Yeah, deep in the money or deep out of the money means it's not the price volatile. Price is far away from the strike price. Either way, if it is deep in the money, the spot price is far away from the strike and giving a high intrinsic value, positive intrinsic value. Deep out of the money means the spot price is far away from the strike price and there are less chance to come back to the closer to the strike price and become its give us a positive intrinsic value.
So this intrinsic value is higher because it is more volatile. Is it the case? Can we consider?
Intrinsic value, no. It's the time value. If the market is highly volatile, time value would be high, not the intrinsic value. Intrinsic value depends on the difference between strike and the spot. Time value depends on the volatility. We'll discuss that in coming slides. We are about to discuss premium, determinants, time to expiry, price of the underlying asset, volatility, interest rate, dividends, how these factors will affect the premium. But this price of the underlying asset, this is almost like the strike. That indeed this is a comparative thing, whether the strike can price relative distance matters. We'll discuss these factors next week. So volatility is one of the another key element. I'm not going to tell you how this volatility and things affect the, or using those, how do you calculate the time value, because all those things will be depend, then it's the option price in Black-Scholes method or the binary tree method that we have to use. I'm not going to do that option pricing, but to understand what are the components of option price and what variables contribute to that and the directions that you would see with the changes in those parameters. Any question? Is it difficult?
No, sir. All the concepts are like similar. That's why it's confusing sometimes.
Yes, usually some. Yes, you have to work out slowly and be clear on that. Then you won't get that confusion. Be clear on what is the call option, what is the right that you get, what is the put option, what is the right that you get. When do you exercise your right as a rational person? If you get to know that, others are just calculation of profit and loss or something like that. Anything
Mr.
else?
Chairman?
Yes.
A basic question I would think. In call option, it's the right to buy no. Yeah. How differentiates the long call and short call? If you just can
yes.
give a basic example.
Right to buy means long call means you have bought the option.
Already bought. Okay.
So when do you buy the option? We call it a long call. Whenever you buy the call option, the right that you get is the right to buy.
Yeah, call option is the right to buy. If it is long call, it refers to already I bought.
Yes. Again, let me correct. Call option is a right to buy means for a long call option. We don't say long call option, but call option, as I mentioned, as I told you, we always talk about from the buyer's perspective or the long position. That's why I said call option gives the right to buy from the buyer's perspective. Buyers from a long position of the call option.
Yeah.
So then the opposite is true for a short call option. That means you don't have, seller does not have any right to buy, but obligation to sell. Whenever the option buyer asks for it, the option seller has to honor that. That means option seller has to sell the underlying asset.
So if it is short call refers to I have gone in for an agreement to sell.
Agreement to sell what?
The underlying asset or whatever agreement.
Yes, you can think that way.
So
if the buyer asks, you have to sell it. Yes.
Yeah. So vice versa for put option also you have the long put and short put.
Yes. Option buyer and the option seller. There should be two parties. One party is buying, other party is selling.
Yeah. So it's a two sides of the
two sides of the same transaction.
Same transaction, no?
Yes,
Okay.
yes.
Thank you.
Anything else? Okay.
I have
Yes.
small question that is in last week question, and it is that how we can use the futures to hit that basis risk.
You cannot use the futures to hedge the basis risk. When you use futures to hedge your position, then you basis risk, because the price of the underlying asset and the price of the futures may not changes by the same amount. That is the basis risk. So therefore, when you do a hedging using futures, you face the basis risk, but it is relatively low compared to the full price risk that you take on the underlying asset. What is basis? What is basis? Basis is the spot minus futures price. So that difference may not remain same during the lifetime of the futures contract. So to hedge your underlying asset or underlying obligation, if you enter into a futures contract, then there will be a price difference between spot price and the futures price. With the time, that difference may change. That will give you a risk. It may not exactly hedge your position 1-to-1, and towards the end, your PNL may not be 0. That is the basis risk. That you have to keep it in your mind when you do a hedge transaction using futures. Is it clear?
That means the futures will not reduce that basis risk.
No. Just because of doing a futures, you exposed to the basis risk. To remove the basis risk, then you have to do dynamic hedging. Every day you have to do the adjustments of the number of futures contracts that you have done to make it a perfect hedging, which we didn't discuss. Then we have to discuss about hedge ratio and things like that. You have to calculate the correlation between underlying price and the futures price, then decide the beta and things like that.
Sir, that we in that section we did the sum in the last slide. No?
That to show you the basis risk, because of the, say, if the market goes up by, spot price goes by 50, I cannot remember the exact figures, but the futures price may not go by exactly 50 points. It may be 48 or 52 or 60. There will be a difference. So therefore, when you gain on one by, say, $50, loss on the other one may be $52. Then ultimately loss would be $2. If it is a perfect hedge, it should be 0. It won't happen because of this basis risk. That's what I wanted to highlight in that last example. I think in that last example, there was a loss. That loss comes because of basis risk. But if the futures transaction was not there, your loss would be equal to that you incurred in the cash market. It is huge. It may be 50 or something like that in that example. But you reduce that loss to the basis risk.
In that example, it says the selling price is 5275. The price in August is 5237.
Hmm.
So if we wait until August, we could have sell at that 5275.
Yes.
So
But
that
at that time, yes, that's what it says. Somewhere it says basis risk is only way that you can reduce the basis risk is hold the futures until maturity. Then you don't face that basis risk. But practically you can't do that because the futures will not match your time requirement.
So usually the investor would not sell that at that lesser price. You can is there any circumstances that forces him to do so?
What do you mean by lesser price?
That means the price is on August is 5275. We have agreed to sell at 5275.
Hmm.
So we have to sell if we are selling that at in August it is we have to sell at 5237.
No, once you agreed 5275, that's the price that you agreed to sell. You don't sell it at the spot price. In the futures, once you agree the futures price, you sell it at that price. In the futures or forward, once you agreed the price, you sell it at that price. You don't sell it at the market price. But in option, it's different. If the market price is in your favor, you do it at the market price. Because you don't have the obligation, you have only the right.
Sell at that price, we have to wait until that August.
Yes. To sell at the futures contracted price, you have to wait until expiry. On expiry only you can settle it completely.
Okay, so okay, thank you.
Okay, thanks. Anything else? So I can see people are leaving. So shall we stop here then?
Okay, sir, thank you.
Okay,
sir.
thank you.
Sure, sir.
Thank you, sir.
Okay, thank you very much. Thank you.
Thank you, sir. Bye.
So please make sure that you revise what we learned during last these 2 weeks before you come to the next class, because it's a continuation. We'll discuss about these options and option premium. Then you need to know when to exercise your option, whether value would increase or decrease with these price movements. So it has to be clear. So please make sure that you revise these things before you come to the next class. Okay, thank you.